The European real estate market is facing turbulent times. Rising interest rates, economic uncertainty, and shifting buyer behavior have left many housing markets vulnerable to dramatic price declines. While some cities are managing to hold steady, others are on the verge of a major correction. Today, we're counting down the top 10 European cities where home prices are set to crash in 2025 and the reasons behind their decline. And before we get started, don't forget to subscribe, like, and hit the notification bell so you never miss out on more engaging content. Let's dive in. Number 10. Monaco. Despite being one of the most exclusive real estate markets in the world, Monaco is not immune to market fluctuations. While prices have remained high due to limited land and wealthy buyers, the rising cost of financing has started to cool demand. Monaco is set to achieve 4% price growth in 2025, with its limited supply and low-tax environment attracting ultra-high net worth individuals. Luxury apartments that once sold within weeks are now sitting on the market for months. While prices have not yet plunged, analysts warn that an oversupply of high-end properties combined with weaker global demand could lead to a softening in the market. One major factor influencing this shift is the decline in interest from Russian buyers, who have historically been major players in Monaco's real estate scene. With sanctions and economic restrictions, their purchasing power has weakened. Furthermore, rising global interest rates are making it more expensive for investors to borrow, discouraging speculative purchases. This has led some analysts to predict that Monaco's price growth may slow significantly in 2025. While Monaco remains a desirable location for ultra-high net worth individuals, those looking for short-term returns may start pulling back, leading to a potential cooling of the market. For now, Monaco's property market remains strong, but with rising economic pressures and shifting buyer preferences, it may no longer be as bulletproof as it once seemed. Number 9. Geneva, Switzerland. While Geneva has long been a magnet for wealthy investors, the Swiss housing market is showing early signs of strain. Rising interest rates and strict mortgage regulations have made borrowing more expensive, limiting access to high-end real estate. Geneva's 3% growth forecast reflects its continued status as a safe haven for global elites, with a strong currency, low taxes, and excellent quality of life. Property price growth in Geneva has already slowed in recent months. With the Swiss National Bank increasing borrowing costs, many potential buyers are finding it difficult to justify expensive home purchases. Foreign investors, particularly from Asia and the Middle East, have traditionally played a major role in the Geneva market. However, with global economic uncertainty rising, many are holding off on purchases, leading to a potential market correction. Additionally, new regulations on second home purchases have restricted the ability of non-residents to buy property in Switzerland. This has led to a drop in demand, particularly in luxury neighborhoods. While Geneva remains a strong market overall, the era of rapid price appreciation may be coming to an end. Buyers who once saw Geneva as a safe bet may start looking elsewhere. If interest rates remain high and economic uncertainty continues, Geneva could see a slower than expected property market in 2025, with some high-end properties facing price cuts. Number 8. Milan, Italy. Milan has been a rising star in the European property market, but 2025 may bring unexpected challenges. After several years of strong price appreciation, the market is showing signs of cooling. Milan secures a projected 3.5% growth, attracting ultra-high net worth individuals leveraging Italy's flat tax regime. One of the biggest concerns is affordability. Property prices in Milan have increased by over 25% since 2018, and many local buyers are now priced out of the market. This has led to declining domestic demand, putting pressure on sellers. Foreign investment has played a key role in Milan's housing boom, but rising borrowing costs and global economic uncertainty are making investors more cautious. Many are choosing to pause or rethink their real estate purchases. The Italian government's flat tax regime has attracted wealthy buyers, but tax reforms in 2025 could dampen demand if incentives are reduced. This would make it harder for high-end properties to maintain their values. Rental yields in Milan are also beginning to decline, as short-term rental regulations become stricter. This could discourage buy-to-let investors, further cooling demand. With fewer buyers entering the market, some experts predict that Milan could see a slowdown in price growth or even a mild correction in certain areas. For now, Milan remains an attractive city for investors, but the days of rapid price appreciation may be numbered. Number 7. Lisbon, Portugal. Lisbon has been one of Europe's hottest property markets in recent years, fueled by foreign investment and digital nomad demand. However, the market is beginning to show cracks. Lisbon is projected to experience a 4.5% price growth in 2025, driven by strong economic performance and lifestyle appeal. A key concern is affordability. The average home price in Lisbon has surged by over 50% since 2016, making it increasingly difficult for locals to buy property. This has led to growing resentment and political pressure to cool the market. Portugal's Golden Visa program, which attracted thousands of foreign buyers, has been scaled back. This has reduced demand from wealthy non-EU investors, many of whom were fueling Lisbon's price boom. Rising mortgage rates have also started to slow home sales. With financing costs increasing, more buyers are delaying purchases, leading to longer selling times for properties. The Portuguese government has introduced measures to limit short-term rentals, which could further impact property values. Investors who once bought apartments for Airbnb rentals are now reconsidering their strategies. While Lisbon is still an attractive destination, 2025 could see a shift from rapid price growth to a more balanced or even declining market. Without fresh demand from international buyers, Lisbon's property market could face one of its first real corrections in years. Number 6. Stockholm, Sweden. Sweden's housing market has been one of the most volatile in Europe, with Stockholm experiencing sharp price swings in recent years. After peaking in 2022, home prices fell by 13%, and while a recovery is expected, challenges remain. Stockholm is expected to see a 6% price growth over the next 12 months. Having experienced a 13% decline from its June 2022 peak, the Swedish capital is now poised for recovery. Interest rates in Sweden have risen significantly, making mortgages 30 to 40% more expensive for buyers. This has put downward pressure on home prices, as fewer people can afford to take out large loans. New housing developments in Stockholm are struggling to find buyers, as developers face rising costs for materials and labor. This has led to construction slowdowns, further limiting the market's ability to rebound. The Swedish economy has been under pressure, with inflation and economic stagnation making buyers more cautious. Many are holding off on purchases, hoping for further price corrections. Stockholm's rental market has also been affected, with stricter regulations limiting short-term rental profitability. Investors who previously relied on Airbnb rentals are now selling off properties, increasing supply. While some analysts predict growth in 2025, many believe the market will remain unstable, with potential for further price declines if economic conditions worsen. For buyers, this means Stockholm could remain a buyer's market for the foreseeable future, with opportunities for price negotiations and potential bargains. Number 5. Madrid, Spain. Madrid has been a standout performer in Spain's real estate market, with strong price growth over the past decade. However, the capital's rapid appreciation is now starting to slow. Spain is forecast to see growth of 2.3% in 2025, nearly double the euro area average of 1.3%. This growth is fueled by tourism and a post-pandemic surge in visitors. One major issue is affordability. Madrid's home prices have increased by over 35% in the last 5 years, making it increasingly difficult for locals to buy property. Rising mortgage rates have further reduced purchasing power. Foreign investors have been a key driver of Madrid's market, but with interest rates rising across Europe, demand from international buyers is cooling. Many are opting to wait and see before making new purchases. The Spanish government's push to regulate the rental market has also impacted investors. Stricter rental laws and potential rent controls could reduce rental income, discouraging buy-to-let investors. Tourism has played a major role in driving demand, but with short-term rental regulations tightening, many landlords are selling off properties, increasing housing supply. If Madrid's economy slows in 2025, analysts predict a potential correction of up to 5% in home prices, particularly in the luxury segment. While Madrid remains a desirable city, the days of double-digit annual price growth may be coming to an end. Number 4. Paris, France. Paris has long been one of the most expensive property markets in Europe, but the city is now facing headwinds. While foreign demand remains strong, economic and political uncertainties are weighing on the market. Despite political instability, Paris is drawing increasing interest from UK and US buyers, driven by a weak euro. Buyers are eager to move forward, having put their plans on hold for several years following the 2024 Olympics and France's general election. Property prices in Paris have already started to decline slightly in 2024, as high borrowing costs and reduced local demand put pressure on sellers. French buyers, in particular, are struggling with rising interest rates. France's rent control policies and new taxation measures on second homes have discouraged some investors. Many property owners are now selling, increasing supply and softening prices. The impact of the 2024 Olympics is also a factor. Many investors held off selling properties until after the event, hoping for a post-Olympics boom. Now, with the Games over, a wave of listings could hit the market. The French economy's sluggish growth has raised concerns, and if unemployment rises, fewer locals will be able to afford homes. This could lead to further declines in property values. For those looking to buy, 2025 might be an ideal time to find deals in Paris, as sellers adjust to new market realities. Number 3. Dublin, Ireland. Dublin's housing market has been red hot in recent years, but cracks are starting to show. Home prices in the city have been rising at unsustainable rates, and experts believe a correction is coming. The Irish housing market is reportedly overvalued by 8 to 10%, and economic uncertainties, including those stemming from Germany's economic struggles, could impact property prices. Ireland's central bank has raised interest rates, making mortgages more expensive and reducing homebuyer demand. Many first-time buyers are struggling to afford properties, leading to slower sales. The Irish economy has also been affected by Germany's economic downturn, as Germany is one of Ireland's largest trading partners. If the slowdown continues, Dublin's housing market could be impacted. Rent controls and new housing regulations have discouraged some property investors, leading to an increase in property listings as landlords exit the market. Dublin's home prices are 8 to 10% overvalued, according to the Economic and Social Research Institute. A correction could see prices drop in 2025, especially if economic uncertainty persists. With more homes coming onto the market and fewer buyers able to afford them, Dublin's real estate boom may finally be coming to an end. Number 2. Berlin, Germany. Germany's real estate sector is facing a crisis, with major developers filing for insolvency and property values declining. The downturn is linked to high financing and construction costs. Germany's real estate market has been in turmoil, and Berlin is at the center of the crisis. Rising borrowing costs and developer bankruptcies have led to declining property prices across the capital. Some of Germany's largest property developers, including Vonovia and Adler Group, have reported significant losses. Many large-scale construction projects have been halted or abandoned due to financing difficulties. Berlin's rental market, which has long been heavily regulated, has also been affected. Strict rent caps have made it less profitable for landlords, leading some to sell properties at discounted prices. Germany's economic slowdown has further exacerbated the problem. With GDP growth stagnating and consumer confidence falling, demand for property has weakened. Berlin has seen a noticeable drop in home sales, with some properties sitting on the market for months without buyers. This has led to price reductions, particularly in the luxury segment. If these trends continue, Berlin could see some of the steepest price declines in Europe in 2025, making it a difficult time for sellers but an opportunity for buyers. Number 1. London, UK. The City of London has experienced a significant decline in property values, with sale prices dropping over 10% in 2024. This trend is attributed to the rise of remote work and changing buyer preferences. London's housing market is under pressure. Home prices in the UK capital have already fallen by more than 10% in 2024, and analysts predict further declines in 2025. One of the biggest reasons is the shift to remote work. Many professionals no longer need to live in central London, leading to a decline in demand for city center properties. Mortgage rates have surged, making it harder for buyers to afford homes. The Bank of England's high interest rates have reduced affordability and slowed the market. International buyers, once a major force in London's real estate scene, have also pulled back due to economic uncertainty and currency fluctuations. Sellers are now offering price cuts to attract buyers, and more homes are sitting unsold for longer periods. With the market correction already underway, London remains the city most at risk of a further property crash in 2025. From London's price slump to Berlin's real estate crisis, these European cities are facing serious housing market corrections in 2025. For buyers, this could mean major opportunities, while for sellers, it may require adjusting expectations. Which city surprised you the most? Let us know in the comments, and don't forget to like, subscribe, and explore Globe Discoveries for more insights. Thank you for watching.